Investing used to seem pretty straightforward, right? You put your money in and you hoped for a good financial return. But today, there's this powerful new question that's reshaping the entire landscape. Can our investments actually do more? Can they create real positive change and still deliver strong returns? Well, in this explainer, we're going to demystify the entire spectrum of sustainable investing. We'll give you a clear framework to understand everything from basic ethical screening all the way to actively funding a better future. So let's get right into it.
To really get why this field is just exploding, we have to understand the core problem it was built to solve. And way back in 2015, Mark Carney, who was the governor of the Bank of England at the time, he gave it a name. He called it the tragedy of the horizon. And it's this fundamental blind spot in finance where we tend to ignore these catastrophic long-term risks just because they fall outside the next business cycle or the next quarterly report.
And believe me, this isn't just some abstract theory. This kind of short-term thinking has very real consequences. When the market is obsessed with the next quarter's earnings, it basically starves the very things that build lasting value, things like groundbreaking R&D. It ignores those slow-burning but massive risks from climate change or social inequality, which just sets us all up for future shocks. And at the end of the day, this isn't just bad for the planet, it's a recipe for economic underperformance. So, here's how we're going to break it all down. We've just touched on the tragedy of the horizon. Next up, we'll map out the entire responsible investment spectrum. From there, we'll dive deep into specific methods like screening and ESG integration. Then we'll move on to more targeted approaches like thematic and impact investing. And we'll wrap up by looking at how investors can actually use their influence to create change. Okay, so let's get to it and map this whole thing out. The best way to think about this is with the investment spectrum. This is really our guide. It organizes every single strategy that falls under this big umbrella of investing with a conscience. And it's going to take us on a journey from a pure focus on financial returns all the way to a dedicated focus on creating real-world impact. So let's start with the big umbrella term itself, responsible investment. At its heart, it's pretty simple. It just means looking beyond the balance sheet. It's the practice of incorporating environmental, social, and governance, what we call ESG factors, into how you make investment decisions. Now, this isn't one specific style. Think of it as the catch-all category for all the different approaches we're about to explore. And this table, it lays out the entire landscape perfectly. If you look at the far right, you've got traditional investing. Its one and only goal is to maximize financial returns. Simple. But as we move to the left, the motivation starts to change. Sustainable and responsible investing starts mixing in those ESG factors with the goal of getting better risk-adjusted returns over the long haul. Take one more step left to impact investing, and now the goal is twofold. You want a solid financial return and a measurable positive outcome for society or the environment. And finally, on the far left, you have pure philanthropy, where the only return you're looking for is a social one. So, the big question is, how does an investor actually put this stuff into practice? Well, we'll start with two of the most foundational methods for building a responsible portfolio: screening and ESG integration. You can think of these as the most common entry points on the sustainable investing journey. First up, we've got one of the oldest approaches in the book, socially responsible investment, or SRI. This is really all about exclusion. The easiest way to think about it is applying a values filter to the entire market. You screen out whole sectors like tobacco, weapons, maybe gambling that you just don't want to profit from. And whatever's left, that's your pre-approved universe of companies to consider investing in. Now, a more modern take on this is the best-in-class approach. So if SRI is about exclusion, this is all about selection. Instead of avoiding an entire industry, let's say the energy sector, you actually look within that sector, and you pick only the companies that have the absolute best ESG track records. You're not trying to avoid the industry, you're betting on its leaders. So what does this actually look like in the real world? Well, a best-in-class fund, something like the MSCI World SRI Index, might target, say, the top 25% of ESG performers in every single sector. And the key advantage here is that it lets you stay broadly diversified across the market. You're not making these huge bets by avoiding whole industries, you're just tilting your portfolio toward the leaders. You'll also hear the term sustainable investment, which is a bit broader and, frankly, more forward-looking. It's not just about avoiding harm, it's about actively selecting companies that are helping to build a more sustainable economy. So, for example, those pioneering ways to reduce resource consumption. It's a wider concept that can use a bunch of different tools, like screening or the kind of deep dive analysis we'll talk about next.
Okay, now this slide is absolutely key because it clears up a really common point of confusion. What's the difference between SRI and ESG? And it all comes down to one thing: motivation. As you can see on the right, SRI is driven by ethics. It's a values-based decision where you say, I just refuse to profit from this. ESG investing, on the left, is driven by financial analysis. The question isn't, is this company good? The question is, how will this company's environmental risks or its social practices impact its bottom line and my returns? So one is about values, the other is about value. All right, now we're shifting gears a bit. We're moving from these broad portfolio construction ideas to much more focused strategies. This next level, it's all about allocating capital with a very clear purpose: to fund the companies that are actively trying to solve major global challenges. Thematic investing is all about identifying these powerful long-term macro trends. So instead of starting with a sector, you start with a problem or a huge opportunity, like the global transition to renewable energy, or the need for sustainable agriculture, or the growing demand for clean water. And then you go find the companies that are best positioned to benefit from and contribute to that theme. And wow, the range of themes out there is just vast. On the environmental side, you've got green investments in areas like recycling or low-carbon power generation. On the social side, you might focus on companies that are providing access to affordable healthcare in emerging markets. And some themes, like building sustainable cities, they really combine both environmental and social goals. Now let's narrow our focus even more to social investment. This is a strategy that directs capital specifically to enterprises tackling social problems, and it often targets the world's poorest populations. It's a concept known as investing in the bottom of the pyramid, the idea of using market-based solutions to create opportunity and alleviate poverty, all while still building a viable business. So what does that actually look like on the ground? Well, it looks like investing in a microfinance bank that gives a small loan to an entrepreneur so she can start a business. It's funding a company that's bringing basic mobile phone access to a rural village for the very first time. Or maybe it's a business developing affordable solar lanterns for homes that are off-grid. Every single one of these creates tangible social value. And that brings us to impact investing, which takes us another big step further along our spectrum. Now, the two words you absolutely have to remember here are intent and measurement. See, an impact investor doesn't just hope for a good outcome, they invest with the specific intent to create a positive social or environmental change. And, crucially, they commit to measuring and reporting on that impact, all while still expecting a financial return. And if you think this is some tiny niche corner of the market, think again. In 2022, the Global Impact Investing Network sized this market at over $1.1 trillion. This is not a fad. It's a massive and rapidly growing force in finance. And it proves there's a huge demand for capital that does more than just make money. So what makes something a true impact investment? Well, it really comes down to these three hallmarks. First, there has to be intentionality. The impact can't just be an accident. Second, there has to be a real commitment to measurement to prove the impact is actually happening. And finally, and this is happening more and more, these investments are aligned with global frameworks like the UN Sustainable Development Goals, which gives everyone a common language for the change they're trying to create. Okay, for our final section, let's look at a completely different tactic: active ownership. This isn't about which companies you buy or sell. This is all about what you do after you invest, how you use your power as an owner to influence a company's behavior from the inside out. This strategy is called shareholder engagement, and the key thing to get here is that it complements all of the other approaches we've been talking about. As soon as you own a piece of a company, you have a voice, and you can use that voice through direct dialogue with the company's leadership or through your vote at shareholder meetings to push for better performance on really critical ESG issues. But you might be wondering, is it actually effective? Well, its success really hinges on a few key things. First, there's the scale of your ownership. Obviously, a huge pension fund has more clout than a single investor, but smaller investors can team up. Second is the quality of the dialogue itself. And finally, you have to have a credible trump card: the threat of selling your shares or divesting if the company just refuses to listen. So there you have it. We've journeyed across the entire spectrum. We started with the tragedy of the horizon, and we've seen this whole toolkit of strategies designed to overcome it. As those long-term risks become today's urgent realities, the fundamental question for every single investor is the one you see right here. Which of these approaches, or more likely what blend of them, is going to define what true lasting value really means?